Hi everyone and welcome to the Tipper Analytics Monthly Update for December 2023. I'm putting this presentation together for my family and friends, the Real Vision communities I'm a member of, and our valued clients of the Ainslie Group, including Ainslie Bullion, Ainslie Crypto and the Gold and Silver Standard. My aim today is to provide some insight into the framework and strategy I personally use to trade my current Bitcoin position, and talking through my logic and reasoning, showing the updated data and analysis tools I'm referencing, and providing the real-time conclusions I've come to. I always welcome feedback and discussion, so follow me on X at Tipper Analytics to stay up to date or to reach out. Before we begin with the analysis, just a quick reminder that everything I say and show in this presentation is intended for general informational purposes, does not take into account your particular circumstances, objectives or situation, is not financial advice, and you should always do your own research and consider obtaining independent investment advice before making any investment decisions. Okay, so to start us off, it's useful to understand the big picture framework I'm using that guides my analysis and financial decision making. A lot of it revolves around the work of Michael Howell from Cross Border Capital and how he defines the concept of global liquidity. The reason I rely so heavily on the work of Howell and Cross Border Capital is because they meticulously gather data on all the components that make up global liquidity each month, much more comprehensively than any other source I've been able to access. I find most alternative sources of global liquidity to be poor substitutes because they either only focus on a small subset of countries and economies from around the world, or they focus on a small subset of important components, with many only discussing central bank money. By not using data that is truly reflective of the entire world economy and all the relevant components, many analysts miss out on a significant part of the whole picture and can end up drawing the wrong conclusions. Global liquidity, in most simple terms, can be thought of as how much money there is in the system. It can exist and be represented in different ways, which is where it becomes complex. But the big picture view is that total liquidity continues to head up over time as world governments create more fiat currency in various forms. Governments have no real choice as debt burdens continue to grow and need financing. So if we look at this chart here, which goes back to 1980, we can see a very continual upward march of the amount of global liquidity that exists in the system to get to that level where we are today, around 170 trillion, when you combine all of those aspects that were discussed on the previous slide. So even though the broader trend for liquidity will always remain increasing over time, there are predictable cycles within the creation of all this new currency that are quite consistent. Governments go through periods of slowing down the production of new liquidity and speeding it up, attempting to smooth out booms and busts in their individual economies. And that's what you can see in this chart that goes back all the way to 1970. You can see there's been very consistent periods where the underlying, which is the actual Global Liquidity Index, is pretty much consistently following the overlaid red dotted line, which is just a sine wave indicating roughly 65 months or every 5 to 6 years that we go through a complete cycle. And you can see, particularly in the latest data here, we've been very consistently following that cycle right down from the high that we experienced sort of around that period of COVID right through to the low that we experienced at the end of 2022. So during these narrower liquidity cycles that we just talked about, periods where liquidity is rapidly reduced create crisis, and periods where the liquidity is rapidly expanded create speculative bubbles. We care about this because if we can move to the sidelines near the peak of the bubble and stay there during the downturns and then enter the market again near crisis troughs, we can significantly outperform simply buying and holding assets. Even though most assets were going to go up anyway over the longer term, by being out at the right time we can accumulate more of them at the bottom as opposed to buying and holding where you remain with a fixed quantity indefinitely. So we've seen a number of these cycles play out. This chart goes over the years since 1990, but you can particularly see, again, what we're talking about, this 2020 COVID crisis that we had up the top here. That was one of those asset price booms with all that liquidity that was injected into the system. And then we went through a bear period in the market where we had liquidity really being withdrawn, even though overall it was heading up and to the right, being withdrawn during this period of time. That led to what we saw with Silicon Valley Bank and other regional banks in the US earlier this year that caused the turnaround and liquidity to need to be injected back into the system again. Moving on to the heat map, which is one of my favourites to look at each month. This shows what it looks like in reality. So we've got the area of green dominance showing a period of rapid expansion, while the area of red dominance shows a period of rapid contraction. So you can see here from that sort of 2021 period, Coming out of COVID, we had a lot of green. We've moved through that period of a lot of red where money was coming out of the system or liquidity was coming out of the system. And I would argue that we're starting to lighten up in the colours and seeing a lot more green starting to emerge in the current monthly data as we move back again towards a period of liquidity expanding. Some assets are better than others at more accurately reflecting the global liquidity cycle. So even though most assets go up over time, as we've been saying in dollar terms, as more total liquidity is added to that system, gold and Bitcoin have two very specific roles because they act as monetary inflation hedges, which means they are among the best assets to specifically select to trade to take optimal advantage of the cycle. So we start this process of analysis by looking at the investable opportunity that might be available in gold, and then we'll continue on to look at it in Bitcoin as well. So looking at gold first, what you can see is what I've done in this chart is overlaid the global liquidity cycle for the last decade. That's this line. And we can see that overlaid with the price in the background of gold. So that's monthly candles. And even though it was a little bit choppy in this period, it still performed quite well, that we had the liquidity cycle somewhat low where we saw the gold cycle low. We got a high, it was a bit choppy here, but the high where we had a little bit of a peak in the liquidity high and another low that low actually lasted right through until we saw the more recent 2020 liquidity high where gold peaked pretty much exactly at the top of that liquidity cycle. So that lined up perfectly. And what we're seeing today is that the September 2022 low in the liquidity cycle lined up, or well, it was actually more like October, but very, very close. That lined up very nicely with the low that we saw in the gold cycle as well. So increasingly over time, and that's what we saw in that previous chart as well, where we were looking at how the cycles were lining up more with the sort of that sine wave over time, we're actually seeing the markets also starting to line up a little bit more closely with that liquidity cycle over time. And that's to do with the amount of debt in the system, which we'll talk a little bit more about a bit later. But we are seeing a consistent pattern unfolding, and we can see it actually in terms of the investable opportunity here, because that low was clearly identified that there would be a time to start buying when we saw that we were bottoming out in the liquidity cycle for gold. So we can zoom in on that chart, and that's what I've done here. This is only over the last 5 years, but what you can see in this case, the yellow line representing the average gold price for the month, it did follow it up very nicely. It's a bit easier to see it when you chop out that earlier information. And really, it probably would have headed down lower, and I keep bringing this up every month. This was the spike that we saw around the start of the Ukraine war. So even without that spike, it sort of headed up, and then we were back down, and we bottomed out pretty much in line with the low in the liquidity cycle that happened in October to November in 2022. So that did line up. You would expect the low to be at a higher dollar price because there's more liquidity in the system than what there was before. So each time it's sort of we head up and then we plateau and head down to form a low and then head up to new higher highs is what you would expect over this cycle. That's certainly what's happened here. And as we've seen the recent tick up in liquidity, so too have we seen a tick up in the price of gold when you average that price over the month. So very interesting that we see almost a one-for-one correlation going on in gold at the moment. So it's a very similar story with Bitcoin, except Bitcoin's the preferred way to trade the liquidity cycle because of the volatility while it remains a relatively young asset. So while it's still gaining adoption, the volatility is actually a feature and not a bug when you try and trade this way, because you get the extremes that allow for much bigger gains in both directions over the course of the cycle. So you can think of Bitcoin as exponential gold. And in this particular analysis that's on the screen at the moment of the relationship between global liquidity and Bitcoin, which was completed by Raoul Pal, we get a correlation of 86%, which is very strong and very significant. And it's even more compelling, this analysis, when you realize that the correlation would be even higher if it wasn't for the exponential upside spikes, which is, as I said, based on where we are in Bitcoin's adoption curve. But those exponential upside spikes actually reduce the correlation slightly. So it's actually a very strong indicator of the correlation to get a number as high as 80 or 0.86 on that R squared that we get for Bitcoin when comparing it to global liquidity. So that is a very compelling reason why I initially started looking at this in the first place. So with that background in mind, we can now apply the framework to Bitcoin to identify the investable opportunity that we're going to ultimately take advantage of. So remembering gold is there, and there's nothing wrong with taking this advantage, this opportunity in gold. But because we potentially can make even more profit in Bitcoin, that's the one that I tend to focus on. I like gold as well, but personally, I tend to focus on Bitcoin because I'm prepared to take that additional risk to get that additional reward, and that's what that exponential gold sort of aspect of it is. So looking at the analysis here, first of all, just note that the background chart in this is actually a logarithmic chart, again highlighting that exponential nature of Bitcoin, whereas when we were looking at gold, it was sort of just a normal linear chart. So you can see Bitcoin again, a little bit choppy in these earlier cycles, but you did get some correlation lined up to the liquidity cycle. But ever since 2018, we got that low lined up very nicely with the low in the global liquidity cycle. The high that we saw in the Bitcoin cycle came a little bit later, but remembering that only just eclipsed the previous high that we saw here. So if you were actually looking at that first high that we saw in Bitcoin, it wasn't long after we'd topped out in the global liquidity cycle. And there was a lot of hype and a lot of speculation that led into these big monthly candles. Remembering, again, we're looking at this on an exponential scale, on a logarithmic scale. So when you think about that, some of the move did come after we'd peaked, but it was certainly within the ballpark of when we were peaking. And what lined up even better this time was absolutely nailed the cycle low in November 2022, right on the cycle low around October, November 22 in the liquidity cycle. So Bitcoin has been very strongly responding to the liquidity cycle and the tops and bottoms, and that's not really a bad it's great for us identifying a time to buy, but it's not really a bad thing that there was a bit of delay after the liquidity cycle had peaked at the top, because that really did give us time to be sure that the liquidity cycle had topped, and we still had plenty of time to get out of that Bitcoin position and would have made a lot of money when you consider the entry price relative to the exit price, and remembering that's in a logarithmic scale. So whichever way you look at it, the liquidity cycle's given you very good tools to use when looking at Bitcoin. And again, we zoom in. Now, this chart is not, this is just on a normal linear scale. So this is the average price of Bitcoin over the month. So you see it moves a lot larger. It looks very flat when you see it before the final spike that happened last time, in sort of coming out of COVID in that situation there. And we, just looking at that closer, you can see that was that double top I was looking at on the previous chart. So we had that top and then a top again, but liquidity had clearly peaked, so we would have been looking for a point to exit. And zooming in close, you can see, yes, we're starting to see the first upticks around here of global liquidity, and that ever since then, Bitcoin has been looking great. That was a fantastic entry. And recently, again, as we saw with gold, Bitcoin really following that tick up that we're seeing in global liquidity. In fact, it's really taken off on the back of that most recent indication that global liquidity is moving higher. So all very positive in terms of our correlation and what we're looking for. So I'm just going to pause for a moment to let you know that this monthly insight is brought to you by the Ainslie Group, Australia's trusted choice to buy gold, silver, platinum and crypto online or in the Brisbane and Melbourne showrooms. If you're looking to buy tokenized gold or silver anywhere in the world, check out the Gold and Silver Standard for the security of real-world precious metals combined with the flexibility of blockchain. We now move from the framework, which was established to tell us why we're looking to trade Bitcoin, to this specific strategy, which outlines how we're going to actually do it and when we'll execute the trade. So I believe strategy and framework are really important. And as it says on this slide here, the strategy that I'm using is that we're going to look at that trend direction that's happening in the Global Liquidity Index. We're going to do a little bit of macroeconomic analysis as well, which is why I do this every month. And I'll just point out, I realize that this is repetitive month after month, that you're getting a lot of the same information, but that's actually, like, I like this term feature, not a bug. Like, that's actually a benefit of a solid strategy. It should be a little bit boring. It should be a little bit repetitive, because we want to be making sure that we are consistently following a set of rules and we're consistently analyzing data in the same way to really take maximum advantage of the opportunity that's presented by the global liquidity cycle. So if you're listening to people who are changing their mind every 2 minutes about what you should be doing, that's probably a negative sign. So I actually treat that as a positive and not a negative, that we do have this repetition that comes up month after month. And I don't apologize for that. That's something that we'll continue to do, because I think that's really important. So we identify where we are in the global liquidity cycle, then when we've built that conviction that the low of the liquidity cycle is in place, we'll purchase upon a buy signal. When we hold that right through to the end, when we start to build that conviction that the high has been passed, then we'll look for a sell signal to exit. It's a very simple strategy, but a lot of detailed analysis behind that to really try and fine-tune when we do that entry and exit to make sure we take maximum advantage and ultimately make the most profit that we can. That's the whole point of the game. So the Bitcoin buy and sell signals are used to fine-tune our entries, and I use my own proprietary signal, but it doesn't really matter what you use. Or it's really whatever you're comfortable with to execute the trade. It's more about building that conviction that the global liquidity cycle low is in, the global liquidity cycle high is in, and then making that decision. What you're looking at on the chart here is a little bit of Bob Lucas's work, so the 60-day cycle work that he does. And I really use this. It's been really useful in this last 60-day cycle just to manage expectations. So we're not trading off these signals. What we're doing is we're identifying. So, well, I'll step back. We have got the global liquidity cycle low in October 2022. That's on the chart. We identified that. Then that was where my signal came in on the 10th of January 2023. So that's specifically when I did my buy and when I told everyone, look, this is when I'm going to enter that trade. These other markings on the chart are the Bob Lucas signals, and what we're more looking at from there is what happened here. So we knew we'd start a new 60-day cycle right back here, and then when we got to this high recently, it sort of managed expectation a bit to say, yeah, okay, we're due for a little bit of a pullback to start the new cycle. So it's not unexpected when you get what we had recently, where it pulled back a bit. I mean, it hasn't pulled back very much at all. It's been just a very short retracement. Bob would look at this and say that we're a very right translated cycle, which is a very strong bullish sign because it spent most of the 60 days heading up and then only a little bit at the end heading down. We haven't moved to a new 60-day cycle yet just because Bob hasn't marked it yet. It's likely to be either here or here, but it also could be lower if it has another move lower. We don't really know yet, but we're around that period of time where we would expect to see a new 60-day cycle starting. So that's actually very bullish as we move into the end of this year, but more so the start of 2024. So I see that as a really positive sign. But as I was saying at the start, really this is just about managing expectations, because as you start to move later into the cycle, you go, okay, I should be expecting some sort of pullback here, just helping you to live the day-to-day life of managing what can be multi-year, and when we're expecting it to be a multi-year cycle. So in that process, you want to just have some tools that help with your psychology to make it really clear to you what you should expect so that you don't panic. You can still assess your framework and your strategy in terms of these tools, but it just stops that sort of panic idea because you've got a fairly good idea of what you expect to happen next. And if it doesn't play out that way, you've got some ideas about what to look for to see what's going to what's most likely to come next in this 60-day cycle framework. So that's what we're looking at there. It's important, obviously, to track performance, and that this will be a slow build over time because we've only got one data point there. But you can see what's happened here is that entry on the 10th of January at $17,179. We're currently up 148% over the last almost a year now at the open of today's candle, and annualized, that's 157%. So, yeah, fantastic result so far, as we would expect, because we're the first year into a bull market that we expect potentially will go for the next, two or so years. So, fantastic start to that bull market. Although it's even more exciting when you consider that historically those bull markets have actually returned the biggest returns towards the end of the cycle. So hopefully we've got a lot more coming ahead in terms of those results in 2024. So that's the updated application of my broader framework and the specific strategy in action for this month. So I'm showing you the logic and the reasoning behind my current active position. The last set of data and analysis tools I take into consideration are too narrowly focused to be really part of drawing that main tradable conclusion, but they do assist, like we were doing with the Bob Lucas stuff, they do assist in building conviction on the current stage of the global liquidity cycle and what to expect next in the markets more generally. Because remember, we also have to keep our interest up. We need to be paying attention somewhat so that we can stick to our guns, so that we can maintain that position over the whole cycle. It's easier to do that if we sort of know what's going on generally and we have a bit of an opinion about that. Makes it much more interesting more interesting than just being a passive observer, putting it aside and not looking at it anymore. So the additional data I'll look at is US focused, reviewing the current trends in consumer price inflation and government debt linked to bond yields, because they're two areas I just like to touch on every month that I think are quite important. So the first one here is the consumer price inflation. Now, I think we really nailed this earlier in the year, where we were saying really we expected inflation to come down when a lot of people were calling for much higher. You can see the government reported rate's currently 3.1. We're on the sort of more accurate metrics we're using here, about 2.84. But you can see it's sort of really quite stable and flat. There's not been any massive momentum behind inflation picking up again, despite what a lot of people will tell you commentating in the market. So yes, we might see it pick up again, but for the moment it's been quite flat. What's important to understand, however, is the difference between consumer price inflation, which is what we're looking at here, the day-to-day costs of goods and services, and asset price inflation. Absolutely, we expect asset price inflation to increase, which is why we're looking at Bitcoin and gold specifically. But all sorts of assets we expect to increase going forward, because that inflation is coming. It's just not coming at the consumer price level at the moment. Certainly, a lot of people argue that 2.84% is still quite a high level of consumer price inflation, but you can see relative to how much liquidity is being pumped into the system, and I'll talk a little bit more about that shortly, that's actually quite stable. So I would see that as a fairly low and potentially stable rate going forward into 2024 as well, given where we are in the cycle. So far, so good on that. Where it gets a little bit more interesting is where we look at the bond prices. So what I wanted to focus on here, and I brought this up last month, and I'll elaborate a bit more again. This chart has been really useful. What I've done is I've mapped the red line is really important. That's the current Fed's funds rate out of the US, and these other coloured lines are the bond yields that you're getting across a range of different bond durations from 2 years up to 30 years. And what's really important about this chart is it was telling us we had a couple of sort of false tops potentially, where we weren't quite sure if yields were going to roll over in bonds. And we certainly seem to have hit that point recently. We've had commentary from the Fed as well that sort of supports this idea that we've hit probably the peak funds rate from the Fed, and they're going to probably start lowering rates. What's concerning me, however, is with the amount of debt in the system and the amount of issuance that's coming next year, that these yields on bonds may start to tick up. Now, bonds and yields get a bit confusing. They're inversely related. So what we might see is, as we start to see these tick up potentially into next year, bonds starting to fall again, which creates some disruption to the global liquidity picture, but ultimately will probably be overcome with more stimulus that's coming from the process the government will need to go through, and the process that the Fed will need to go through to actually get this actual Fed funds rate lower to where it needs to be, which you would expect on the back of some tougher times probably in the economy more generally. But why this is particularly going to get my focus over the coming months is we just need to be paying attention to if we do see these yields start to tick up, and it possibly could happen. I'm starting to come to an opinion. I'm not fully convinced on this yet, but I'm starting to come to an opinion that those yields could tick up even against a backdrop of the Fed lowering rates. And you'll see historically, the Fed's lowering rates and yields are heading lower with it, but it's not unprecedented to see, like we had here, where we had very low Fed fund rate for a long period of time, but much higher yields over that same period of time. So I think we may possibly be entering a period of that where the Fed funds come down, but those yields potentially stay higher. I'm not saying that they, shoot off to the moon, but that they stay much higher than expected, just because of all that debt, that issuance that needs to come. So that's something to pay attention to into 2024 that may alter our ultimate understanding of where we are in the cycle, which will be relevant when we're trying to identify that peak in the global liquidity cycle. Still not expecting that for a long time yet, but these are the sorts of things that we need to be paying attention to all the way through. So my final thoughts for this month, I just thought I'd leave a little bit more focus on that debt. I know I talked about this last month as well, the interest payment on the debt specifically, but this month, just looking at this chart, and it was pointed out to me earlier today that really this is a little bit of chart manipulation where, they're doing it in a linear scale, and really if you did it in a log scale, it would look different. But that's fine. But I think it still highlights the point. It took a very long time to reach 7 trillion in debt, and this is US government debt, and now we've just got this hockey stick shape where it just has taken off. I think this is really important. It didn't take us very long at all. We're talking, less than or just around a couple of years to really get this last leg. And there's not really any indication that anyone is taking this at a government level, certainly taking this seriously, that there's anything to stop it. So it's very good for us in terms of our Bitcoin trade, very bad for us down the road in terms of being human beings and thinking about what this means for the economy, because really there's nothing in place. We've got an election year coming up next year in the US. So, there's nothing in place to stop this just continuing straight up. And that is really quite concerning and something that we all need to be paying attention to as it unfolds. So, like I said, great for the liquidity picture and great for us in terms of these trades, but something that more generally will be a focus for 2024 that I think we need to pay attention to. So that's it for this update, and thank you for watching, and also for the year. Hopefully you find it valuable to step through this process with me in this format. As I mentioned at the start, always welcome feedback and discussion, so follow me on X at Tipper Analytics to stay up to date or to reach out. I'll be back next year in January with the next monthly update. I'll keep them very consistent so that we can follow this as it unfolds and really understand what's going on, to reassess and identify what's changed and make sure we're absolutely prepared, both mentally and actually ready to go when that time comes in the months and hopefully years ahead of this bull market in crypto and liquidity. So I'll talk to you again then, if not sooner, on X, Discord, or the Real Vision platform. Until then, Merry Christmas, everyone. I hope you have a safe and prosperous new year, and good luck in the market.